Welcome to my channel. I'm James, and today I'm going through my valuations methods of the Caterpillar stock, ticker symbol CAT. We're going to be looking at their financial statements, then using two different models to give a price target of the stock, using discounted free cash flow models and the Buffett-Graham intrinsic value. Is this stock a buy or a sell in 2022? But first, what is Caterpillar Inc? It's a company that manufactures and sells construction and mining equipment, diesel and natural gas engines, industrial gas turbines, diesel electric locomotives worldwide. It has a construction industry segment which offers contractors, pipe layers, road reclaimers, telehandlers using utility vehicles, resource industries which has electronic rope and hydraulic shuffles, tractor types, mining trucks, wheel loaders, wheel dozers, landfill soil compactors, energy and transportation that has powerful generator sets, engines integrated for the power systems, marine, oil and gas industries. Also has a financial product segment which provides operating and finance leases, insurance and risk management, and as well as other equipment related loans. Company was founded in 1925. So if we look at the share price over the last year, you can see it's actually done pretty well. Over the last year, it's gone up 17% from around about 191 to 228. It was at its all-time high at 244, dropped down from that, but has rebounded strongly and has earnings coming up very soon on the 28th of January. If we take this chart a little bit further back, you can see it was hit pretty hard in the pandemic, was at $90 a share and has then gone on a absolutely crazy run to $240 and is now at $288. Now we're going to look at the financial statements of the company, but first, Caterpillar Inc. has a market cap of $123 billion. It's in the industrial sector. Share price said before 288 and had a 52-week low of 197 and has a 52-week high, which is about its all-time high at 246. It has a 1.94% dividend. And why I'm saying buying this today, because the ex-dividend date is the 19th of January. So buy your shares before then if you want that dividend. So buy now. Firstly, is the PE ratio less than the market? Yes, it is 24.48 compared to 26.59, so that is a pass. Next, we want to look at the revenue of the company, and this is the amount of money the company brings in from goods or services it sells. We want it to increase as it shows growth, but we need to compare with the expenses, which will be the next step. But as you can see, it's gone from 54 billion to 48, so that is a fail. If we look at the revenue here, and let's go to the annual numbers, you can see it went 54, 53, 41 and 48. So it has bounced back from 2020, which is a good sign, but still down from where it was at 2018. Let's hope that this can continue in the right way. Next, we want to see is the profit increasing, and the profit is the profit or loss of the company. It's the net income, and this is total revenue minus total expenses. We want this increasing in positive, and as you can see here, it's gone from 6.1 billion to 5.1 billion. And once again, if we look at the income statement here, you can see that profit is down, one from 6.1 to just under 6.1, but 3 billion in 2020. So that has increased quite dramatically. It's back to where it was, which is a very good sign. Next, we want to see if the shares outstanding are decreasing. The shares outstanding refer to the company's stock held by all its shareholders. Companies can buy back these shares, purchase them off the market, which then reduces the amount of shares outstanding. For example, if a company has 1 million shares and 2 million income, it has $2 per share earnings. If they buy back half of those shares, the shares will then be 500,000 and they'll now have $4 per share. So what are Caterpillar doing with those shares? Well, they are buying them back, gone from 591 million to 544. So this is good because it means that they think the stock is undervalued and they're buying it back at a good price. It also then creates a level of support of the stock. And finally, it increases share prices because as there is less supply on the stock and the demand is high, the number of shares outstanding have decreased. Therefore, it will increase the stock price. What we are looking for here is the free cash flow increasing. What is free cash flow? Well, it's cash from operations minus capital expenditures. Company can use this to invest in more capex. They can pay dividends to shareholders. They can acquire other businesses, or they can use it to buy back stock, which they are doing. But it's gone from 3.6 billion to 5.5. And if we just have a look at the cash flow statement on Yahoo Finance here, you will see that it has increased pretty steadily, even in the pandemic year. So that is once again a very good sign. So overall, we have 3 passes and 2 failures. The 2 failures are the revenue and profit, but it is increasing from the pandemic year, which is good. They have a free cash flow ratio of 22.33, which is the market cap of the company divided by the free cash flow. Very in line with the PE ratio, which is good to see, a little bit lower in fact. And the dividend is safe because they have 5.5 billion in free cash flow and they're paying out 4.2. Finally, we want to look at a discounted free cash flow model and the Buffett-Graham intrinsic value. You can see I've estimated the future free cash flows of the company, and then that calculates a total value of the company discounted to today. And well, what does this say? Actual stock price 288, calculated stock price is $314.74, which means it's at a 37.48% discount. So discounted free cash flow really likes the stock. Then we look at the Buffett-Graham intrinsic value, which takes expected growth rate into account and earnings per share and bond yield. And you can see here with this massive expected growth rate of 33.34%, this actually has a fair value of $386.61. So once again, trading at a massive discount. What I want to show here as well is if we just quickly compare to Yahoo Finance and see what the analyst was saying, this expected growth rate was very high at 33%. So if we just sort of look at the numbers a little bit more tapered here, obviously Yahoo Finance is breaking right now, but let's just refresh the page. You can see that over the past 5 years, they've done it about 26%, and in the next year, they're expecting 20. So if we change this to 20, that would still be at $250 a share, which is a massive, which is still an increase, but not as big. And the other value, which was 26%, would then give you a fair value of $311.12 a share. But analysts are a little bit higher on that, and they're expecting this to be 33%, which would be a fair value of $386. And finally, what are the analysts saying? Well, they're thinking it is a moderate buy, 6 buying, 3 holding, and 1 selling. Average target price of 236, high side of 290, and a low of 164. So we are actually a lot more bullish on this stock than analysts. This stock has had a crazy 2021, and let's hope it continues into 2022. Right, guys, thanks for watching. Please give a like on the video, and I'll catch you guys next time.